Best of times or worst of times for clean tech? And we'll start with you, Jonathan.
Clearly best of times, without question. I'll caveat that by saying best of times with substantial challenges, very substantial challenges. But notwithstanding that, when we started Solazyme in 2003, which is not that long ago. It was 6 years ago. But when we started it, there was actually really nobody out in the space investing. And there weren't any other companies doing this either. And oil was also $18 a barrel. And at the very early stage, I remember, and I'm sitting with a bunch of very, very accomplished investors on this panel, but I remember early on, we went to go talk to some of the very small number of venture capital firms that were investing in energy, who said to us, and I'm talking about literally a handful of firms at the time, said to us, well, what you're doing sounds really, really cool, taking algae and making fuels out of it, but we don't know anything about life sciences or biotechnology. You really ought to go talk to the biotechnology guys. And so there were plenty of those guys in the Valley, and we went to talk to some of those firms, and they said, well, actually what you're doing sounds really cool, but we really don't know anything about energy. You ought to go talk to the energy VCs and see how that works out for you. And so the reason I say that is people talk to me all the time. They say, well, what about $35 or $40 a barrel oil? Isn't that really hurting your opportunities? And I say, well, no. It was 18 when we started the company, and we're adding a tremendous amount of carbon that was fixed millions and millions of years ago to the atmosphere every day, and we're sending money to parts of the world that don't like us a lot every day, and we need new energy solutions. And eventually, by the way, on top of all that, there's going to be a cost of carbon. So I say that the recognition of the problems is so much greater today than it was 2, 3, 4, 5 years ago in the public sphere, that definitely best of times and a great opportunity for people who are looking at going into this area. The best times are ahead. You know, you may look at this as students and say, there's all these companies, they're already in there and they're doing all these things, and some of the, low-hanging fruit's probably getting picked. And I say, no. I say, this is the beginning. And the opportunities out there are really, really amazing and substantial. And the work that's going to get done in this area that everybody's talking about 15 years from now will include many things that nobody's talking about at all today. And so definitely best of times.
Fantastic. Actually, let me ask this question to cut that short. Do others disagree with Jonathan's answer? Anyone think it's the worst of times? Let me reframe the question then for the rest of the panelists. Marion, what do you think the single biggest challenge that you face as a venture investor is right now with clean tech investing?
Yeah, I think it's a good question. And I realize you wanted to cut the sort of the non-ending agreement short, but I just do want to pile on to Jonathan's comment a little bit.
Absolutely.
Part of the reason it is the best of the time is just look around this room. Look at the level of enthusiasm and interest in clean tech and what's going on in this industry, and that's the reason it's best of time. There's so much energy and enthusiasm focused on this, and it's in the entrepreneurial base, it's in the technical innovative base, it's in the policy and government base. I mean, there's just very serious interest, and that's why it's the best of times. Now, coming to what the biggest challenge is, one of the, or certainly one of our challenges now is certainly there's no secret we're in the middle of a financial crisis, and that's not a great thing. And one of the knocks against clean tech is that some of the businesses are relatively capital intensive. And if you want, one of the things that's great about energy and clean tech markets is they're massive, they're very big, they are large established markets, and a lot of the end products are commodity products. And so you have large markets with very little market risk if you can produce the product. The issue if you're going to make something at very large scale, if you're going to make something that sells into a large-scale market is scale probably matters a lot, and cost probably matters a lot, and cost and scale go together. And so one of the challenges in the industry now is how do you build that first plant? If you can get your first plant up and running, then other people will follow. There's always a race to be second. You proved your economics. You took all the risk out of it. Somebody's lined up to be number two. And there's an issue today because of how tight the financial markets are. Where is the money going to come for the first plant? And that is a real issue facing us today.
What do you think, Raj? I'm going to skip, since it relates to your exact same business, do you see the exact same challenge Marianne does, or a different set of challenges?
Let me pivot back. So I think right now it's a great time to be an entrepreneur. Your costs are down, expectations in terms of salaries are down, availability of people is up. So it's a great time to start a company. It's also a great time to be VC. Right now you've got valuations coming down, expectations are coming down. The greatest returns in the history of venture capital have always come at the tail end of a downturn. So the next venture cycle is going to be likely a really great cycle for us. Back to the challenges. Look, I think it's an incredible time to start a clean tech company. Notwithstanding the macro market, you've got policy fundamentals that are coming in your favor, not just in the United States, not just in California, but globally. You've got an administration that even last night just pounded the table. The first initiative that they talked about was energy, of the three major initiatives. So we should see something coming out of 2010 budget that's positive. We certainly saw that out of the stimulus package, which really helped the solar industry with the changes in the investment tax credit. And the big challenge to Marianne's comments right on, I think financing large-scale, capital-intensive businesses is going to be very, very difficult. The debt markets are all but shut down right now. And so if you're going to finance a facility with all equity, it's a very expensive way to do it, and the returns are relatively low. And so that challenge, I think, will sort itself out over the course of 2010 into 2011. But that is the short-term challenge right now, number one. Number two, no one knows where the market's going to go to, and so people are sitting on their hands right now and not investing. And so that's, I think, a short-term problem. I think as things start stabilizing, as the stimulus package starts kicking in, we'll see more fundamental investment pace and cycle reemerge. Right now, people aren't investing a lot.
That's helpful. JB, it'd be great to hear from you, your perspective, not just for Tesla, but for the electric car industry in general. Best of times or worst of times?
Well, I think I would echo a lot of what Jonathan said. No, not to agree too much, but it's definitely best of times. We started back in 2002, late 2002, and it was such a different world than it is today. Even including all the financial crises, everything else going on today, there's so much more interest, so much more awareness. There'd be like 5 people in this room if we had this panel in 2002, and I think for the entire electrification of the car industry, plug-in hybrids, basically regular hybrids, pure electric, battery electric cars. There's more excitement and more discussion, more R&D dollars going into that today than there ever have been in the past. So, it's hard to characterize that anything other than best of times. But it is, the same challenges apply. Capital availability is really, really hard, and just like other clean tech companies, whether it's building an end-integrated car or just a battery factory or pieces of electric powertrains, whatever it might be, those are all really capital-intensive things, and you do have to get to a large scale before you can really be competitive and start generating a profit and compete. So that's probably one of our bigger challenges right now, is how to structure financing and structure the future of the business.
That's helpful. Let's go back to one of the comments that Raj made, which every panel.
Mitch, if I can, if I can just add one thing, because it may seem slightly insincere that we're all sitting up here and saying it's absolutely the best of the times, given that there is some turmoil out there. And so I do want to add some color and say, why is it the best of times? And if I look back to, say, 2 years ago, which you might argue was a better time, right? I would actually argue that there are a number of things that have been helpful since 2 years ago. And so 2 years ago was maybe the height of the enthusiasm in clean tech, and valuations were very high. And certainly Raj's point that people are slower to invest certainly wasn't true 2 years ago. And so why would this be a better time than that? And I think one is certainly the policy changes that we've talked about, that there's a lot of support coming. But the other thing is when you had a period of over-enthusiasm in the marketplace, and so valuations were too high, sort of the capital dollars that were available to companies were too high. And you frankly have companies that are doing things that are not thinking about their business smartly in that kind of context. And so there was this kind of I can do everything concept in terms of really not thinking about what the core value of the company was and how to exploit the core value of the company and building a company in the ecosystem that it needs to work in and establishing that core business. And so I think one of the things that's been very healthy about the shift in the external marketplace is people are getting back to basics, and they're thinking about what am I doing that's really valuable, and how do I extract the value for the piece that I really do well. And so I think that's very healthy in the industry, and I think my panelists would agree, but that's part of the reason I really do think this is the best of times.
go at it from a slightly different angle, just for the heck of it. I might argue the best of times was in September of last year. While capital is still available, and people nonetheless were thinking about some challenges, and I think still operating in an environment which is quite competitive. I wonder whether or not there's been such a fundamental shift in terms of the lack of debt that there'll be a complete change in terms of where people fund new businesses, and that capital intensity is really the hallmark of the core decision as to whether or not a VC will invest or not. Do you think that I'm off on that, Marianne? Do you think that you will shift where you invest from more supply side to demand side businesses over the course of the next 12, 18 months?
So I think capital, Raj and I both talked about capital, and JV as well. Capital clearly matters here. And so I think that there's two different factors coming together. One is that the supply side companies got out of the gates first, right? So the first set of investments that venture made were around solar and biofuels. And so those are out of the gate first. And so there's companies that now we have to play through what happens there. And so I think there will be a set of waiting to see what happens with that first generation of companies. And for the solar companies, I think a number of them have enough money that they're sort of clear. I think it's more of the plant-based biofuels, coal gasification, these kind of big solar thermal, these kinds of projects that are bigger. And then there will be some waiting to see what happens. But I think that's partly a shift because we've already kind of covered that sector at some level, and we're moving on to the next one. On those first set of kind of capital-intensive companies, I think you'll see a lot more strategic partnering. I think you'll see a lot more activity in those directions. Certainly, I think there's a lot of waiting to see what the government will do and where loan guarantee programs go. So I think there is a bit of a shift that will happen there. But I think the other thing that's really important to understand is part of the reason the investment dollars went to supply side first was that they were very easy places for innovation. So one of the challenges in clean tech is that they're big industrial markets. They're not areas that entrepreneurs have typically been resident in before. So if you think about high-tech, information technology, and biotech, we have generations of repeat entrepreneurs who have been successful. They understand the industry that they want to innovate in. They think about what the market need is. They come up with a new product, service, business, whatever, that targets that. In the case of clean tech, there aren't a lot of entrepreneurs in the power industry. There aren't a lot of entrepreneurs in the fuels and chemicals industries. There aren't historically a lot of entrepreneurs in the sort of the vehicle and transportation industry. And so what you had to have these disruptive innovations that you could bring to market without actually knowing a ton about the industry you wanted to be in. And so supply-side technologies are very natural for that, because if I can make a solar panel that sells at 5 cents, that gives you power at 5 cents a kilowatt hour, I don't need to know what my business is. I can hire those people later, and I know that I'm doing something valuable, and they can figure out how they're going to get distribution into market. They can figure out all of these things downstream. But you understand there's something valuable in that core material scientist. And kind of the same thing on the biofuel side. If you could make a fuel that was cost competitive with oil at $20 a barrel or something like that, you don't have to question whether it's valuable. So you can fund the scientist, you can fund the very early team while you build out the business in terms of how are you going to get that product to market. And I'm way oversimplifying. But on the demand side, you actually really have to understand your customer base. You have to understand, there's a massive problem out there. Yes, it would be a much more cost-effective if we were all more efficient and we didn't build more supply. But you have to figure out the customer who's going to buy day one, that's going to sort of start the market solution that you can expand the market opportunity from. And you need somebody day one who's from that marketplace. And as we have more and more focus and more attention on clean tech, those kinds of entrepreneurs who have industry experience and industry insight and the thinking around the business models, they're coming to the marketplace. And so now we have sort of the ripeness of the opportunities to invest on the demand side.
I'll pick off that. On the demand side, and I agree with a lot of what Marianne said, a lot of it's regulatory driven. So you're working with utilities, you're working with independent system operators. There's a lot of policy that drives some of that, particularly around efficiency, smart grid, and rollouts for AMI and the like. So there is a little bit of a challenge there that you can't work in a vacuum, to Marianne's comment. You've got to work with in the framework of what's happening on the policy side.
So I would actually add something that kind of plays off this, and it's a little bit skewed to the side, but it also has to do with what some of the opportunities are. And and this isn't out of my own head, but the more I've thought about it since I heard it, the more I realized it's really quite accurate. Listen to a lot of people in the same kinds of positions that Solazyme finds itself in, which is we've really wrung a lot of the technology risk out of the company, and we've scaled it up, and we've demonstrated it works, and we've made in-spec fuels, and we've road tested them, and we've done lots of things. And so, to the comment Marianne made about one of the big risks being, how do you get that big commercial steel in the ground, and how do you get it running? That is a major issue, and we talk about how the debt markets are really effectively closed now, which is clearly true. But what I heard somebody say over the last couple of days, and I've been thinking about it a lot since I heard it, was somebody said to me, there haven't been in the United States a lot of big factories, whether they were for energy or for semiconductors or for there haven't been a lot of big first-of-their-kind technology factories funded in this country really since the 70s. And the more I thought about that statement, the more I really realized it was true. And the comment came, it was tied into something else, which was not only, if you look back to when a lot of those first big, huge, expensive semiconductor plants were built and things like that, the comment was the people who funded those plants, the project finance people who did that work, they're all retired now. And there isn't a generation of finance people that has funded first-of-its-kind technology in the U.S. I mean, you can point to examples where this isn't true, clearly, but as an industry-wide thing, in a long time, and that's so complaining that a closed debt market is the only obstacle is not necessarily accurate, and that this is the interesting thing is from a timeline perspective, we're now at a point where there are indeed a whole host of companies that are coming upon this exact situation, and some of how this gets resolved is going to have to do with the creativity of the individual companies and the opportunities. Examples, and one was already mentioned, there will be a lot more strategic partnering. There'll be more of a blend of how commercial relationships are structured. Think about how the corn ethanol industry was structured. They never envisioned 5 years ago that the price of a bushel of corn could go from $2 to $9, but it did. And so they weren't backward integrated, they weren't upstream integrated in the feedstock, right? They were buying spot market things. We have to look at those kinds of things as we build new businesses, and we have to understand what some of those mistakes were. And maybe we don't build a greenfield plant. Maybe we refit something that's out there. Maybe we JV. And I think that the comment that meant a lot is you are going to have to watch how some of these companies tackle these problems moving forward, because they're very real and they're exacerbated by a shut debt market.
Let me just go in a slightly different direction. I think Jonathan's point is right on. Let me ask you, JB. Obviously, Marianne made reference to government loans earlier. It'd be interesting to get your perspective on government loans and also hear a little bit more about your sense of what role government should play. I mean, you guys are undertaking a fundamentally hard thing to do. You're creating a new car company, stunningly bold thing to do. What's your sense of the right role of government in this, and tell us a little bit more about your sense on government loans.
Well, I think the programs that the Department of Energy, the DOE, is undertaking with loan guarantees, for advanced energy technology companies, whether it's solar or vehicle technologies, batteries, things like that, are a pretty good structure for this. Unfortunately, today it gets just totally confused by the whole bailout and TARP fund, and it's such a mess right now that nobody really has a clue whether you're applying for a loan or you're getting a bailout, even though they're entirely different things. Right. I was in D.C. last week, actually, and working with the DOE. We're applying for one of the advanced technology vehicle manufacturing loans. And this is a program that they actually approved. Congress approved $25 billion for this over a year ago. And, the DOE, unfortunately, spent the entire last year just sort of embroiled in process with a bunch of different startup companies. And, the new administration has really lit a fire under them to start progressing more quickly on these things. But I think that's a great way that they can really, help stimulate and incentivize development and work and, development of potentially new plants, new manufacturing, things like that in this space. The challenge is, can they do that intelligently and not just basically throw money out the door at every single person that raises their hand and then end up losing 3/4 of it. That's going to be the interesting balance. It's both exciting and terrifying as a taxpayer, to see how that process is unfolding, and exciting as an entrepreneur because there's a lot of opportunities there. So,
let me ask a question of both VCs on the panel. 5 years ago, I think we could count the number of VCs who are active in this space probably on one hand, right? Now, I think we can probably count the number, and obviously both of your funds were active 5 years ago. Now we can probably count the number of VC funds who don't seem to at least be interested, probably on one hand, right? Is this a space where there are too many people, or do you think chasing too few deals, or is that an unfair characterization?
Sure, let me jump in. There is way less capital than there are opportunities in clean tech. We're just skimming the surface, right? Most of the focus has been on solar and it's been on fuels, effectively, right? We're skimming the surface on energy efficiency. We're skimming the surface on water, resource management, waste management, stuff that just hasn't seen innovation in decades. And so that's number one. Number two, the venture industry has changed substantially in the last 10 years, right? It's gone global. And so as a clean tech investor, you've got to think globally. We've got now 9 companies outside of the United States in clean tech, right? There's 3 in China, 3 in India, 2 in Israel, 1 in Europe. I may have added that wrong. But there's enormous opportunities globally, and there's not enough capital for venture-style investing globally in those markets yet. It's coming. India's still coming on board. China's got a lot of capital, but I just think the opportunities are huge. I think we have not done a great job expanding beyond, as a broad class of venture investors, beyond the 2 primary target areas, and we're slowly starting to do that. There's great clean coal opportunities. There's really good innovation happening in water. A lot of good water technologies coming out of Israel. They've got huge water problems. There's some innovation that can be had there. So I just think we're just starting. One thing I think it's interesting that we talk about all the time, in the 80s, the venture market looked historically for markets that were 500 million. In the 90s and up through 2000, it was $1 billion market was a market you can invest against. We're now investing against 10 to 20 to 30 to $50 billion markets. And so that's what drives our excitement within our partnership to continue to do this. And we're on a timeline that's a 30 to 40-year time window. This is not a short-term thesis. Marianne?
Yeah, I would agree. And I think one way to kind of look at this is the category clean tech. And we've sort of tossed around some different subsectors of that. And I think the issue is that clean tech is so broad that really it should probably be subdivided into different categories. And then you would see that the venture investment is actually quite thin. And so to drive the point home, I think there's a lot of attention focused on how quickly venture investment in clean tech has grown and how high the dollars are. And I don't have them exactly right. I think it was $8.5 billion in North America last year, which is certainly a lot of money. It was the 3rd largest investment category. But when you look at sort of the detail against what it was compared to as the 3rd largest investment category, I think the 1st largest is software specifically around media and communication. So it's a sub-segment of tech. It's a very specific definition. And so when you compare, and the other one was a sub-segment of life sciences and biotech investment. And so clean tech, which includes all power technologies, all transportation technologies, all manufacturing technologies, agriculture, air, water, all transportation, all of these sub-segments is still the 3rd largest It's still, one of a smaller investment category, shows that we're still very thin. And I think what it is showing is that we are, and this kind of comes back to the point that we're cycling through sectors, right? So we're doing solar, and then we're doing biofuels, then we're doing efficiency, and we're doing other things as we go. But it's partly because there's not enough people and there's not quite enough attention. At the same time, the whole ecosystem has to grow, right? So the venture investors are there, but we need more entrepreneurial talent to come into this pool. We need more management talent, and this is one of the key issues in clean tech companies. They are fairly raw, and so they're pretty time-consuming from an investment perspective. And as more and more talent comes into the space, then those companies can get off the ground more quickly, and so some of the limiting factors kind of disappear. The ecosystem is still being built. The talent in terms of entrepreneurs and management is still being built in terms of coming in. But going back to Jonathan's first point, this is the very beginning of something. As this ecosystem grows, it gets much stronger. As a case in point, Jonathan and I were both at the Clean Tech Forum this morning in San Francisco, And I think it ended up being, 1,000 people or something. I heard that there were about 1,000 people there. I think 4 years ago, the attendance on that thing was 150 people or something. And so that ecosystem is growing, and it gets momentum as it grows.
It was less than 100 5 years ago. Yeah, that's absolutely right. Yeah. Actually, Jonathan, I want to have a follow-up question with you, if we could. Marianne touched on both talent and ecosystem growing, and we also sort of touched in her answer a little about categorization. And you had made a comment earlier on in your panel about how when you first went out to try to raise funding, biotech or tech investors would tell you to go talk to life sciences investors, and life sciences investors would tell you to talk to energy investors. Let's talk about building that team. And has it been easier for you? You've been at it for a long time now, very effectively. Is it easier to find talents today as an entrepreneur than when you co-founded the company?
You said effectively, and you didn't see the sausage getting made. I mean, it's been an incredibly time-consuming and difficult process, and we've made mistakes along the way also. I think that the first thing that you need to realize, and we were fortunate because we picked this up quite early, is we're trying to build something that's incredibly multidisciplinary. And there's absolutely no chance that you're going to be able to pull the pieces from any one small area. And I'll give you an example of just the kinds of things we've surrounded ourselves with. So everybody talks about strategic advisory boards, and everyone talks about advisory boards and how you build a company. It's a great way to help bring in investors and have validation. But, I have a few people who have actually built companies in the space that I talk to several times a week. A guy who built a company in the fermentation-based bioplastics business. A guy who ran a company in large-scale industrial. Another guy who ran a company in large-scale industrial fermentation for food products. Another who is the head of technology at a very, very nearby local industrial biotech company and has been there since 1982. And these are people who I literally talk to several times a week. And then beyond that, you're talking about process development people, the kinds of people that spent their careers at Cargill and ADM and Tate and Lyle, companies that you don't normally associate with venture investment. And so you have those guys. Then you have the molecular biologists, and some of those come from biopharma. And then, you have to look at your application side. What markets are you going into? And you have to have application people that know how to take your materials and prepare them and test them to see what they're good for, whether they do what you need them to do. And they can come out of things like, for us, they come out of things as varied as fuels, having people from ExxonMobil, and cosmetics. People, that have backgrounds from Estee Lauder, and so that one of the most interesting things, and you got to realize it kind of early, is that the senior management team needs to be quarterbacking, and not, necessarily micromanaging and calling the day-to-days, because there are just too many pieces, and you have to hire great people from each of these areas. And often, one of the most interesting things I think is that a lot of these people that you have to pull together for companies like this is the first time they've ever been in a company like this, because there was not another opportunity in their career to be in a company like this. And that's one of the biggest challenges from a recruiting perspective. How does somebody understand something simple like the value of equity? How does somebody who spent their career in the Midwest moving from big industrial fermentation plant to, agricultural processing plant, are they, they look at home prices in the Bay Area, and the first thing they say is, "Are you kidding?" I mean, and these are very simple, kind of basic problems, but they're very, very significant on a day-to-day basis when you look at how to build a team. So, yes, over time we've been effective, but we've been around for 6 years, and like I told you, watching the sausage get made has not been pretty.
Just a follow-up question. What percentage of your time do you spend recruiting now? And what percentage of your time did you spend recruiting 5 years ago?
It's cyclical. It's cyclical, and we've slowed down recruiting a bit now. We're quite candidly budgeting for more runway than we had initially intended to, which I think is the right thing to do. I don't know when things are going to get better. So I'm spending less time than I would have been if we were kind of on our initial glide path. But I was spending, well, certainly upwards of 50% of my time recruiting, and probably it's something less than that now, but it's still a pretty significant number.
Sort of a couple crystal ball questions. JB, what's your sense of, I want to actually ask about the electric car industry. What's your sense of what the biggest innovations in storage will be over the next 5 years?
So I would say it's generally related to batteries.
Yeah.
I don't see too many other storage technologies that are going to really compete there.
You guys chose lithium-ion, right?
That's right. We use lithium-ion. It's lithium-ion is a really broad moniker. It covers a whole slew of different chemistries and a bunch of different types of technologies that you could actually put into a battery. It's a lot more generic than saying lead acid or something like that. And I think lithium-ion as a category will continue to be the area of innovation for probably at least another decade. We work with battery vendors all around the world, in Japan and China and Taiwan, Korea, and all of them have really vibrant roadmaps for innovation going out 3, 4, 5 years. And there's tons of really great ideas coming that can extend the energy density, how much energy you can cram into a given weight of battery by a factor of maybe as much as 100% over the next 10 years. So I think there's incredible room for optimism. That's one of the biggest enabling technical fields, for transportation, for partly for renewables and a number of other technologies. So I think startups in that space are really helping drive the innovation because there's so many more startups today than there were 5 or 10 years ago. And those startups are kind of sowing the seeds of innovation into the bigger companies that turn into products a few years later.
And where do you think the electric car industry will be 5 years from now in the United States?
Well, certainly bigger than today. I think far bigger than today. And it's kind of at the point right now of you said in the United States, which is challenging because most of the companies in the United States are really struggling for survival right now.
There's a follow-up question coming up.
I think in the U.S. it's going to be hard. Most of the companies right now are scaling back innovation to the minimum or cutting it off entirely just to get to survival. Maybe they're clutching to a few product innovation cycles, but I see by far the biggest volume, the biggest advances happening outside the U.S. The European companies really get this, the Japanese companies, and the Chinese. Almost everybody else seems to be doing more in this space than the U.S. companies, which is kind of scary.
Well, that's a good lead-in then to another series of questions. And let me sort of just go down the row. Raj, you started by saying I think that you have 9 investments right now in your portfolio outside the U.S., split between China, Israel, Europe, and India. If you were to just sort of guess where DFJ will put its bets over the next year, what percentage of the deals, how many deals do you think you'll do? What percentage of them do you think will be based in the Bay Area, based in the U.S., and based outside the U.S.? And obviously that's a tough category because there's going to all the businesses will have international aspects of them. But
within clean tech or overall?
Within clean tech.
Okay. We are likely to do more in clean tech in the United States than elsewhere. That being said, we are incredibly active in China. Our China team is dedicated to finding the great clean tech companies in China. We're investors in a large wind blade company there that is the #1 wind blade company in China there. They'll do multi-hundreds of millions in revenue last year, incredibly profitable. So those opportunities are just substantial in those 2 markets. That said, true innovation, really, really good innovation, most of that is still the United States. There's a lot in Europe and renewables as well, but Europe is somewhat of a broken venture market. So I think in the U.S., the transition that happened in sort of my career in clean tech here at DFJ has been most of our deals in the first part of this decade were outside Silicon Valley. We had no clean tech companies in Silicon Valley up until about 3 years ago. The innovation was happening in places like Atlanta, Chicago, a lot in Boston. But that's substantially changed. Now I think close to 70% of clean tech investments in the United States are now in the Valley, which is impressive. What was the second question? Number of deals. Our deal pace has slowed down substantially. We used to do about 2 deals per month overall. In clean tech's about 30% of our portfolio, so do the math. We're probably down to doing 1 deal per month, 1 to 1.5. And so,
sorry,
go ahead.
Good job. Marion, how about you? What's your sense of both the pace of investing and then the geographic focus of that investing?
Yeah, so I should start. So by saying that MDV is quite different than DFJ in terms of our kind of geographic focus. You guys have how many offices?
Yeah, we've got offices in 23 cities globally.
Wow, much more. So in contrast, MDV has one office. It's here in Menlo Park, just up the road from here. And so that implies a very different focus. And we're really, although there is certainly opportunity around the globe, in clean tech markets, I think particularly so, one, because a lot of times the markets start elsewhere, although certainly they're global markets. And in those cases, we're really looking for fundamental innovation. And as Raj said, I think fundamental innovation still is, there's a lot happening in North America. And so that's really our focus, is where there's fundamental innovation, going after global market opportunities. There are significant opportunities in domestic markets. So India and China are just burgeoning market opportunities, and I would not be surprised if the next great vehicle company came out of India and China, kind of working from the bottom up. And those are great opportunities, but they're not something MDV is doing. So MDV is focused domestically. So all of our deals, I think, pretty safely will be in North America, although there are sometimes exceptions to that. From a pace perspective, I would, it's hard to estimate, it's hard to say, but I think we're going to be roughly in the same zone that we have been. And so from a clean tech perspective, I think it's going to be 2, maybe 3 deals in the next year, and something on that order.
Jonathan, you had made reference, I'm going to come back to the international theme again, but you had made reference to the cost of carbon in your earlier comment. What do you think the carbon markets will shape up like here in the U.S., and is that vital to your business?
The one thing I'm sorry, because you might want to rethink a question to me, because the answer is I have no clue. Okay. Honestly, I'm not kidding. I really don't. There are so many different things going on that are potential.
It's this way.
Are we going to end up with a cap and trade system? I guess there's a decent chance that'll happen. Would we be better off with a carbon tax? Maybe.
I don't mean from a policy perspective. Let's take it from a more from the perspective of the way you actually operate your business. Do you think of carbon, pricing as something that's important to the way that you model your business, or no?
No, but there are caveats like with everything else. And so, one thing that people think is they think that the U.S. hasn't done anything to regulate carbon yet. And I'm not talking about AB 32 for anyone who follows California law, by the way. But that's actually not true. In late 2007, the Renewable Fuel Standard passed and was signed into law, and it has a very substantial component, 20 billion gallons by 2020 something, I don't know what year, but 20 billion gallons of advanced biofuels, and one of the definitions of advanced biofuels is a biofuel which reduces carbon intensity by more than 50% over competing petroleum-based fuels. That's something that's actually been on the books. It's something which obviously we haven't hit. I don't know, maybe it's something like 2015 before that advanced biofuel mandate kicks in. I don't remember the exact year, but we've already started to regulate it. And what that means is businesses that are serving those fuels markets know that it's coming. And by the way, that's one of the few things that is driving some level of seriousness among, for instance, big oil companies, knowing that there will be some kind of mandate. And there's a lot of complaints and a lot of pushback on all kinds of mandates, but we view the mandates as an important part to get to some kind of moderation of carbon. As long as it's ends driven. And the difference between ends and means is another part of that RFS requires corn ethanol, and another part of that RFS requires biodiesel. And our personal view on this is that any renewable fuel standard shouldn't be specifying any technology. Right. What it should say is we want X gallons of renewable, domestically produced fuel that reduces carbon footprint by, Y% over competing petroleum-based fuels and meets certain pre-existing fuel specifications, and then let the market do its thing. But unfortunately, that's not the way it's shaped up completely. I think there'll be more of a move toward that level of technology agnosticity and ends-driven, but there's still room for danger there from our perspective.
Totally acknowledged. Let's
Mitch, if I can just make one comment, and I'm not going to answer the carbon question either, but I think some of your questions have kind of hinted around or touched around policy, and what's the role of policy here. And so I thought it might be useful to just say one thing about certainly the way MDV invests, and I think other investors as well. And so we think policy is really important as a tool that can be leveraged in something that can give tailwind and can support to an industry. But we don't fundamentally invest in companies that rely on supportive policy to be successful in the long term. And so maybe we'll just take Jonathan's example as Jonathan's case as an example because he's talked about it a little bit. So the renewable fuel standard is there's a bunch of things that go on in fuels. There's the renewable fuel standard. There are tax credits. There are different things that are helpful in establishing the marketplace, in giving you some sort of market umbrella that you can have some time to walk down the cost curve. And so those are really valuable things. These are things that we consider to be wonderful, and they're great leverage for startup companies because they give you some certainty around market in the near term, and they give you a sort of a pricing umbrella that you can walk your technology down a cost curve. But to the extent that that business in the long term depended on those kinds of government mandates to say that somebody had to deploy this technology even though it was non-economic, even though they didn't want to, that's not a market that's fundamentally attractive to us. So it's about technologies and products that make economic sense when they get to maturity. They make economic sense on their own, and they're supportive on a subsidy-free basis. And to the extent that we can take advantage of subsidy and policy on the way there, that's a fantastic thing. And so when you talk about carbon, the way we look at carbon today, and businesses coming in for the most part are pitching carbon as upside, in terms of price of carbon. And so they have some economic value today, and if carbon ends up having a price, this is upside for them that grows the business. And as just one example, a company I talked to yesterday, they have some technology that does carbon dioxide separation, and this is useful technology. And certainly to the extent that we start mandating carbon dioxide and putting a price on it, it's fantastically useful. But that's not what they're talking about today. They're talking about, hey, it turns out in natural gas pipelines, I really have to get rid of all of the carbon dioxide because it makes it much more efficient to distribute and pipe. And so there's an industrial process today that depends on getting carbon dioxide out of some kind of ambient liquid or some kind of ambient atmosphere. And I am price advantage, cost advantage in that application, and this is how big my market is. Step 2, I'm going on to this market, and the holy grail is, hey, when I go to sort of coal stack flue streams and I get ambient carbon dioxide out of the ambient air because I'm paid to sequester carbon dioxide. But that's not his business. His business is these industrial applications where it's valuable to take the carbon dioxide out and for their own industrial purposes. And that's a good way to think about these businesses, things that leverage policy that provide sort of a cushion in the near term or provide great upside in the long term, but you have a fundamental business that makes sense without those policies.
One last question. When you think about economics, obviously you're competing into different markets. How much do you think the price of what happens in China and India will shape ultimately the closing price for where we are 5 years from now?
I'll let you take that one to start.
It's driving it right now. I mean, Suntech is a low-cost producer of traditional silicon. They have incredible capacity. Their manufacturing costs are lowest in the business. Suzlon went from nothing at the start of this decade to now the 4th largest wind turbine company and wind systems company in the world. They've got 13,000 employees, something like $6 billion in backlog. And so I think when we think about our companies here, we think about them competing not just with innovative companies out of the Valley or out of the U.S. We think about them competing with low-cost producers globally. And you have to because they're shipping their stuff here, right? I'll leave it at that, I guess.
I think that's right. I mean, we've talked about it as global markets, and in many cases, sort of commodity markets, and price wins in those cases. So you absolutely need to be cost competitive against whoever the low-cost manufacturer is. I think the other thing that the other direction that I think is significant, and I'm sure you're seeing a lot of this, is that the innovation in those. So that comment, the first comment, kind of applies to global markets. So if I talk about wind turbines, or I talk about LED lights, or I talk about solar panels, these are kind of high-tech products that go for global market opportunity. They're kind of manufacturing technologies, and so there's a relatively low-cost base internationally that you have to be conscious of. I think the other thing is in international markets, their pockets are frankly, their pockets are not as deep, and so their expendable income is much smaller. And so they innovate in different ways in technologies that we just don't think are relevant to us today. And so in China, for example, I think virtually every rooftop has solar hot water. And so they have these little kind of effectively balloons that sit on their rooftop that heat the water, and then they use that for domestic hot water in the housing. And we have very little solar hot water in the U.S., and the way they do it is not at all relevant to us. But that technology will develop, and it will grow, and it will mature. And at some point, it may become crossover technology that becomes relevant to our applications. So I think there's also this bottoms-up effect from China and India, that they innovate on things that are useful to them today that have nothing to do with us. But as they certainly walk up that technology innovation scale, they will start to be relevant to us.
Raj, when someone comes in to pitch a company to you, and you're sort of evaluating risk, if you're evaluating the team and the execution risk of that team, if you're evaluating the market risk, you're evaluating the technology risk, and you're evaluating the finance risk, the future capital needs of the company. Which of those four risks are you most concerned about today when you look at a company?
For me, it's fundamentally the team. And so I spend most of my time just getting my arms around the founding team. I think, the market's not big enough. It's digital for us. We won't invest, right? And so that sort of takes care of itself. We do that work. Technology risk is what we do as a business and as a class, the venture class. And so I think the biggest challenges for venture investors overall is just validating the quality of the team. Because the markets are going to move, the technology is going to get delayed. There's a lot of challenges. You need to recruit a fabulous team. And so, visionary leaders recruit well. And so trying to find that person who can do that is the biggest challenge for venture, whether it's in clean tech or otherwise.
Marianne?
Yeah, I would have to say the same, and at the risk of agreeing too much. I think, we did start by saying that the challenge in the industry today is financing for some set of companies. And so it may seem that we should be highlighting financing risk as the first risk. But I think the reason it is team is because great teams will figure out how to finance a company. They will figure out what dollars are available, whether it's strategics, whether it is government dollars, whether it is a venture investor that understands the specific proposition and gets really excited around the company. And so great teams are the critical lever to removing financing risk, and certainly they're the lever to figuring out market risk, technology risk, and all of these elements as well.
Let's follow up on that. JB, how similar is the Tesla model, today, the business that you have today, from what you started with, and what are some of the key inflection points?
I would say that the vision for the first product is amazingly similar. That's the one thing that's really endured through this entire period from founding till today. The scope of the operation, the scale of the challenges, the time, the general future roadmap for the company are all just radically different. I looked at some of our first business plans, and it was like, profitable in, a year and a half, $10 million raised. And it's,
Not that you didn't believe it.
Not that we were totally passionate, fully believed that was the way to go. But
we believed it too.
Thanks. But, I think a part of a good team, or part of being able to adapt to those changing conditions. And you can never predict with 100% certainty. It's probably not the right thing to do, even if you could. Right. 5 years ago, or looking forward 5 years, how a company will evolve or how the markets will change. And the market environment today is just so different than when it was when we started that the answers we came up with then would be totally wrong for today. We're trying to expand more quickly and move out of a high performance niche more quickly. Yep. 5 years ago, at least in our case, electric vehicles were seen as almost dead. Our main competition were fuel cells, and that was kind of seen as the future of the automotive technology. Today that's hugely diminished, and it's something that we really don't spend much time even discussing. You don't have to sell the idea of the technology or what we're trying to do anywhere near as much.
If you want to get a VC to invest in a car company, just give him or her a test drive in your vehicle, which is what you guys did. They literally, it was incredible. They had their first test vehicle, and they drove around Silicon up and down Sand Hill Road, and they gave interested parties rides. And once you took a ride, you said, I've got to buy one if I can afford it, and two, I want to invest in this company. And so product tangibility is incredibly important, whether it's a car company or any otherwise. Just having something that's tangible, whether it's a prototype or really sort of turns or perks up a venture investors.
Well, let's talk about that. When, right now, JB, do you think that folks are buying Teslas because of performance or because of efficiency?
Oh, it's such a difficult thing to characterize. Our customer base is split, kind of evenly between 911 drivers and Prius drivers, and it's so hard for the typical auto industry or marketing execs to try and figure out what market that is, because it isn't a traditional market. Yep. But to emphasize your point, product tangibility and being able to market directly to people's passion for environmental solutions and sort of managing their own carbon footprint and those kind of things is really critical. It has been for us. We chose not to go into a wholesale market of trying to sell battery packs or powertrains or things like that immediately, where we would have been selling to OEMs and other customers like that were basically oblivious to the sort of prevailing interest in the market. They were just focused on cost and their own internal economics, and I think that was a huge benefit to us. So it's not possible in all clean tech areas, but I think where it is, you have an interesting opportunity to really leverage consumer preference for things that are potentially environmental, CO2 reducing, that sort of thing.
JB, let's go back to you with the same question. How close is the Solazyme of today to the company that you thought you would be when you co-founded it, and what were some of the key inflection points?
The answer to the question you didn't ask is that we...
That's a good one, too.
The answer to the question you didn't ask is that the only reason we're here today and the only reason that we're doing as well as we are is because not only did we make a lot of mistakes, but we recognized them and we're willing to do things to rectify and make sure that the company was directed the right way. Some of the best things we do now are based on learnings that were very painful at the time. That's a kind of a tritism, but it's still an important one because, well, let me back into the end. We started the company, there were really two things we were looking at, and they both involved algae, and they both involved fuel, and they both involved photosynthesis. Okay, one we were looking at early on was hydrogen, and another we were looking at was oils for liquid transportation fuels. And I mean, everything happens sequentially, and the first thing we dismissed was hydrogen. And we dismissed hydrogen because we just quite candidly didn't believe that the infrastructure to ever do the production was going to happen, and even if we succeeded there, where was storage and usage and ... And then the second piece of the puzzle was, okay, well, we can do liquid transportation fuels by producing oils. But it was in the same paradigm that I think we started in, which was, hey, we're going to deploy this in big open ponds and or photobioreactors, and we're going to let direct photosynthesis provide our chemical energy from which the algae will make oil. And this is a more technical answer to your question, but it's certainly something that I think is kind of interesting. And what we realized, and the technical part of this isn't the relevant part. The relevant part is it was a brain-scratching aha moment that didn't have to do with the science. It had to do with kind of recognizing a fundamental reality, which for us was that algae are really great at making oil, and whoever drove here today drove here on some liquid transportation fuel that probably originated with algae a long time ago. So we knew they were good at making oil, and the hard part was saying, well, hey, it's really two processes. It's photosynthesis to make chemical energy, and then chemical energy conversion into oil. And we scaled up. We were running big ponds. We were trying photobioreactors, and it was kind of working. But it wasn't working that well. And we had some money in the company. It wasn't a lot of money at the time, but we had some money in the company. And we actually got to a point where we said, you know what? I just don't think this is really going to work. And we had been dabbling in a couple of other side products into cosmetics and nutraceuticals, things that we've always.
How far were you at this point? How far into the company's life cycle?
A year.
Okay.
And then not that long after that, we went to these guys and said, this isn't going to work, but we have two things we want you to support. We want you to support these other applications, which could be, cosmetic, nutraceutical, even potentially pharmaceutical, although we don't have a target yet. And the second thing we want you to support is a second approach to fuels in which we split it and we feed algae biomass from other sources. Other plants which we think are much more effective at the photosynthetic process to create chemical energy. And they said yes to both. And I'm still stunned they did. Absolutely stunned they said yes to both because, not only did we not know what we were doing, but they didn't know what they were doing either. I mean, look, I'm brushing over this, but I'm being honest. Part of this was we said there's another approach. We really hope you'll support this. And ultimately, they did. And that's the technology through which everything we do is based now, and we've scaled it up and demonstrated it. But the answer is the general idea is the same. The technology is actually extremely different. Yep. We use the same organisms, but we grow them completely differently.
Fantastic story. I mean, that was a year in. How many times have you thought that Tesla would die in the life of the company? I don't mean this to pick on Tesla at all. I'm just saying.
I don't know if
phone up on the point.
I mean, you can't really think it's going to die along the way, or else your sort of fate is sealed. If you give up hope and your internal core team doesn't believe you can make it.
How many times have you bit your nails or had sort of aha moments?
I mean, lots of times. That we've had lots of turns and twists and changes along the way. And I think the thing that's maybe different with us is the technology has stayed more similar throughout it. And batteries have been getting better and better. And I think we've stumbled upon a lot of major surprises in how difficult it was to solve the battery problem that set us back and caused us to work a lot harder. But those also turned into opportunities because it turns out it's that hard for everybody. Yep. It wasn't the case of we were on some totally different path that just was harder than the other guy was. The entire trip ends up being a lot harder than everybody expected. So, in a way, that's that could be a silver lining to it.
I would just point out before I open up to questions from the audience that I think there's a very common theme in the way that everyone answered best of times. And I also think that there's a very common theme in the way both JB and Jonathan answered the question about how their businesses have changed, as well as how Marianne and Raj identified the team was the most important. I mean, time and time again, if there's one pattern we see, it's that smart teams get their way through tough jams. And that's really the history, I think, of when we look back and figure out the early years of clean tech innovation in the country. I think that will be the one takeaway that will be very consistent.
What's the promise of flywheel energy storage? I actually worked on that a little bit before Tesla, and I think that they have a really tough time for energy storage. They might be a good solution for power buffering. I think transportation will probably be the last place they get applied because of the potential safety issues and dynamics. In the stationary market, there's already a couple of companies doing pretty well there, Active, Beacon, Pentadyne. It is basically a replacement for UPS, uninterruptible power system batteries. But it's a tough market. I think they're a technology curve that has a lot shallower improvement rate than batteries do. And when we were working on this 7 years ago, we were kind of neck and neck with batteries. Batteries have gotten far, far better, faster than anybody expected, especially in terms of power and life and cost. And those are sort of reducing the market scope of where flywheels can effectively compete.
So the question relates to the stimulus package and how people are adapting to it.
I can take a shot. I mean, the stuff that we're working on is a little bit parallel to the stimulus package because it's related to the DOE loans, but I think largely the entire idea of really trying to expedite this and using some of the loan programs and everything else as an economy stimulus, which wasn't quite why they were invented, but it will help get that done faster, and it'll help cut down the political process of getting approvals and different stamps of approval and this and that and the other thing. We're spending a lot of time on it. I probably spend 15% of my time just on those issues because that's the one part in the market that the government still is funding things, and there is quite a bit of capital availability for these kind of projects. So that's a good opportunity.
I'll jump in. The one provision for clean tech or renewables that was key in the stimulus package was dealing with the investment tax credit. And so we had a market that was a $16 billion market in September that shrunk to a $2 billion market overnight. The number of players were 25 who were active in tax equity, which funds a lot of these projects. That number, 5 of them failed, went out of business. Another 10 turned unprofitable, which means they can't use the tax credit. And so that singularly changed the direction of solar for 2009, 2010. It is a huge provision that they put into the stimulus package, which is going to save the renewable industry for at least this year. And so it was a very smart decision. It was, the venture industry was incredibly active with the Obama administration. And they were incredibly active with the venture industry, trying to figure out what the right way is to get real jobs in the ground this year. And so a lot of the stuff that they'll take care of in new energy bill will be handled for long term, but the short term was getting jobs in the ground, and solar was the change in the investment tax credit was a big issue.
Part of your question was how much. So I think certainly the stimulus bill is good, and we're happy about what's in it. But I think part of your question was how much is the venture community or startup companies working on legislation or with the agencies in terms of policy and support. And certainly, I think this is an area that is interesting in clean tech because historically, venture investing in startups and sort of lobbying and government were very, very far apart. They did not meet. And certainly in clean tech, they are meeting. And there has been a lot of work. And Raj is right. The new administration has been extremely sort of receptive towards new ideas. And they've had a lot of outreach to the community, whether it be from startups, whether it be from industry, whether it be from venture capital, about how do we really get things moving. And so they've been very receptive to new ideas. And so there has been a dialogue. For us, we've really been working on it, one, from an understanding perspective, to know where it's going and where how to think about it correctly for our company. And then also to set the foundation right for the industry. So when we've been working with either the agencies or the Hill, we've been trying to think about things not so much with respect to our specific companies, but what are kind of the foundations, to Raj's point about the investment tax credit, we need that for the industry to move forward. So what are these kind of foundational things that we need to get everything set right so that we can move forward?
I think the amount of policy that companies that are, still very much venture-backed, A, B, C, D round companies, the amount of effort that needs to get put in on the policy side right now is actually pretty significant. And I think it is very different than what's come before. And I can say I personally spend an awful lot of time in D.C., and whenever I'm in D.C., I'm not here, and that's problematic. On the flip side, the industries that we're entering are ones that are highly regulated. There's all kinds of economic incentives already in place. For instance, I'm on the liquid transportation fuel side of the world, and as everybody in this room knows, the number of hidden subsidies in petroleum products is absolutely enormous. The big oil companies have had 100 years to bury incentives and financial advantages, all over the place. And so in order to make sure, again, to Marianne's first point, we need to build a business that stands alone. And we feel very strongly about that. But notwithstanding that, there are things that policy and governments can do to help us get these technologies commercial much more rapidly, and we think it's important to be there at the table. It's tough to try and balance those, particularly in early-stage companies. You would never expect a company with 60 people to be spending a lot of its effort in Washington, but unfortunately, we feel like it's something that we have to do.
And just to sort of echo that, I work with companies that are certainly clean tech sector and a couple that are outside, and the numbers of companies that deal with lobbying on a regular basis or think about non-dilutive financing outside of the clean tech sector, it's really 2 or 3 of my portfolio of my clients. Just the opposite for the number of clean tech companies that don't think about it and spend a substantial amount of time thinking about it. So the question relates to why is this sustainable and why won't it go away like the fits and starts we had at earlier times?
I can say a few things. I think the technology underpinnings behind what you have today are far more substantial and real than they were in that time frame. like in wind industry, there was this huge dash into doing wind turbines of every different type and sort, and when you were making wind, electricity at many tens of cents per kilowatt hour, it was hugely expensive, and the time of function of those turbines was really short. There were a lot of different technology problems that people hadn't even begun to sort out, but it was just a dash into the market. Whereas I think things may have not totally gone away. They kind of went into hibernation and slow evolutionary innovation for a decade or more, 2 decades, and have kind of reemerged now with a lot of experience and a lot of technology that's matured for quite a long time. And things might not be 100% competitive in every space, but they're close enough that you can have companies that are competing that aren't 100% reliant on subsidies, whereas in that period, I think the reliance on subsidies was far, far higher. So when they went away, the companies went away.
Polar bears in Bangladesh.
Other questions?
So just the last thing I would add, so certainly technology is very close to its other externalities. In the 70s, the other thing was that it was kind of an artificial contraction, right? We had a supply-side contraction, and then we caused all these pricing increases. And it was really an artificial situation. They opened the spigot, everything went away again. Today we have a very different problem. And so we have kind of a supply-demand imbalance that's causing tons of volatility in commodity pricing, and certainly I think long-term upward pressure. And that's because supply is tight against demand. Demand is really growing on a worldwide basis, and yes, we're in a recession, so it's down a bit. But the industrialization of the rest of the world is putting a lot of strain on resources, and that's why we're having these pricing increases.
So the question is, what's the quality of tech coming out of the labs, and will there be much that's commercializable soon?
There's a lot. I mean, there's already half my companies pull out IP from either the national labs or universities. We invested in a solar cell company, multi-junction solar cell company out of Stanford. We just funded the 3 founders, pulled them out a year ago. There's tons of stuff. All of our portfolios are riddled with companies that have IP out of universities or government labs.
Yeah, there's lots of technology that's already coming out. And I think that one of the things that's really important underpinning, again, for the clean tech industry is that if you look at every major research university across the U.S., the big initiative on campus is some kind of energy, environmental initiative. And so they're pulling together big cross-disciplinary efforts, certainly at Stanford, at Berkeley. There's these big efforts. So it's physics, it's engineering, it's computer science, it's chemistry, it's biology. There's these cross-disciplinary efforts really putting technology forward. And so there's a lot today, and there's going to be a lot more.
I may take a slightly different viewpoint from inside a startup. The definition of soon is sometimes challenging because we work a lot with. Well, we've taken a lot of people from those industries, and hired them into our company. But it's very hard to apply most of the things that they're doing to sort of immediate problems that are relevant to us on our time scale. If you're starting a brand new startup with a whole roadmap in front of you, it may be more viable. But to try and commercialize or take piecemeal things coming out of universities and national labs is really hard.
I would just say that from 2000 to 2005, I never worked with a client that didn't have its technology coming out of university or national lab. As the generations of companies have changed and there's been a shift from supply side to the demand side, that's starting to not be the case anymore. But I don't think that it means that there's less innovation happening at the national labs or universities. I think it's just the opposite.
I would tell one quick anecdotal story about that because I think that technology coming out of universities is the basis for a lot of the many, many great companies, even in the Valley here. What I would tell you, though, is I think that at the investment level there's been an over-reliance on that. And I'll give you an example of what I see as a problem with that. You spin a technology out of a university, and it comes with a brand-name professor who has patents and an ego and a share of the company ultimately. And then, as happens with early technology companies, you realize, well, hey, you know what? This isn't really the right direction for the company. But there's a professor, there's IP, there's ego. How do you change directions? And I honestly do see that as one of the challenges. And I think that when technology comes out of universities, it should come into companies with management teams that have an understanding that their mandate is to build a successful company and not necessarily hook or by crook to commercialize that technology in its most obvious form. And I think that that's frankly been the death of a lot of companies over the last 5 years that we've watched in the clean tech sector.